Okay, so you got the final exam. There's only 3 problems. It's basically similar to the midterm. You got the tech company, you got the stock, and then you got the investment decision-making matrix. Really simple, okay? And then work with me on getting your memos ready, because the memos and the pitch book are 2 of the major deliverables that you're going to walk out of here. And if you work with me on both of those, you'll walk out with really good products, that you'll be able to use. Okay, and I have some extra copies of these. What I would do is take pictures of as many of these as you can. But I pulled these out yesterday, and I thought that these were some of the best ones from the last few semesters. So you're gonna produce one of these in your teams, okay? And what I'll do is I will walk you through. You've already been exposed to the methodology of valuing stocks. Now this is basically an application of the exercises that you did on the midterm. Okay, but now it's application. All right, and we're going to do Goldman Sachs. Okay, Goldman Sachs is one of the top investment banks in the United States. They're almost $1 trillion in assets. They're about 800, 900 billion only. Right. We're JP Morgan and B of A, those guys are like a couple trillion. But Goldman Sachs is really interesting. They are totally connected politically, both in New York and Washington, D.C. A lot of the ex-Goldman Sachs people end up going into government in Washington, D.C. And a lot of and when they're done doing their term in Washington, they go back to Goldman Sachs. Okay. Goldman Sachs is more leveraged than the other banks. Goldman Sachs is known more as an investment bank as opposed to a commercial bank, although it's expanding into commercial banking services. Goldman Sachs is very aggressive. They do a lot of things that other banks aren't willing to do, and some of the things that they've done were legal but unethical. They really kind of push the limits. They are probably the blue chip investment bank. If you're ultra high net worth, you probably bank at Goldman Sachs. Your advisor is from Goldman Sachs. And obviously all the top 5 banks basically compete for all of the top talent coming out of the Ivy League. And you can just see it when you look at the top leadership. They're all from Harvard and MIT and Wharton and NYU and places like that. Where if you come here and you look at Wells Fargo, most of their leadership is from Berkeley and State and more of a local. They pull more from the local universities, which I think is kind of interesting. So here's the production of this is very, very specific. Okay, you can make it hard on yourself, or you can make it really easy. Okay, and I say let's make it easy, right? So it's very, very specific. Okay, we've been working on this. Let's see, one of my graduate students at Golden Gate, I did this maybe 7 years ago, and she basically designed this template, and then we've been refining it over and over again every semester, and I think it's pretty much perfect. Okay, I'm not saying that all of these are totally perfect, but I tried to throw away the ones that were garbage and just keep the ones that are really good, so that you can see what the good ones look like. Okay? So it's very, very specific. The first thing is you have to have a clear cover, okay, that you can see through. Not an opaque cover, a clear cover, because the first thing that the investment committee looks at, where the board of directors or senior level management, or your clients, is going to be the front page, okay? So you got to be able to see the front page very quickly. These are normally branded. You do not represent the bank, okay? I need to be clear on that. You do not represent the bank. You are basically an equity analyst, or you are a public equity analyst. You might be working in a family office, in a public equity firm. You might be a CFA, equity analyst, working in a bank, working in an investment firm. So you don't represent the bank. Okay? What you're doing is you're valuing the bank and then coming up with a recommendation. This pitch book is the style of this pitch book is used in every function within the corporation and the institution. When you're doing presentations to the client, this is the way it looks like. When you're doing presentations to the investment committee, the board of directors, senior level management. This is the pitch book, okay, that you use. This is called a pitch book, or it's also called a deck, okay? And usually what you'll do is you'll forward on the deck. There's usually a memo or a report that goes with this, that you will forward on to the investment committee or the board of directors a week before the meeting in most cases. And then they come in, they've already reviewed it, you do the presentation in front of them. Usually takes about 5 to 8 minutes to do the presentation. If you go to 10 minutes, you went too long, okay? And then you do your pitch, and then you just field questions for 10, 15 minutes, and then you're done, okay? But in our case, you're gonna be doing the 5 to 8 minute presentation. You're gonna be professionally dressed. I'm gonna record all of your presentations and make them available to you. I'll go up onto the website and I'll show you, where you can get other templates and where you can get some of the videos from prior student presentations. I only put the best ones up there, but it gives you a good idea of the professionalism and how some of the students have really approached this, okay? And I'd say that, I've taught at a lot of different universities, and I would say that the St. Mary students are really, really, really good students, and they present really, really well, if you take it seriously. And I think you should, okay? Because we've worked on this for a long time. So the first cover page, you're going to be doing Goldman Sachs. The recommendation is right there.
So everyone does Goldman Sachs?
Yeah, I'm going to have everybody do Goldman Sachs. If I made you do I'm really just training you how to do this, as opposed to making you do an individual bank individually for each individual team. I think that would create too much confusion. What I want to do is kind of streamline the process here. At the end of the semester, free up some resources for you, because I've already taken so much resources from you over the 2/3 of the course, and give that back to you so that you can focus on your other classes, okay? And we'll just kind of slide into the final, okay? And the final's not in class, it's take home. So what we'll do on the very last night is we'll come in, we'll spend the first half hour just chilling out. We'll be putting your deliverables together. I'll do an exit lecture, which is basically a 7-module system that basically gives you the intellectual infrastructure that you will need to be able to move more decisively in both your academic and in your working career, so that when you're confronted with compelling decisions or decisive decisions, you can make that decision very quickly and know that you made the right decision. Okay, and there's obviously people like me and others, hopefully that you've created relationships with, that you can rely on to get some biased or unbiased feedback on those challenges that you may be confronting, and again, to be able to make decisive decisions very quickly and know that your decisions are correct. Okay? And if you could do that moving forward after this semester, it's going to save you a lot of time and agony and cost, okay? Because we haven't invented a time machine yet where when you make a mistake and you make a bad decision, that we can go back in time and correct it. Some of your decisions that you make are correctable, but some of them aren't, and you're just going to have to live with the consequences, okay? So here we have the intrinsic value, final intrinsic value right there. I usually do 1 decimal point right there, and then the current stock price is right there. So I like them right next to each other, so I can quickly see the intrinsic value compared to the current stock price, and then confirm the recommendation. Then you're going to calculate the premium or discount to the stock. So I know that right there, and then who the team is. Do not brand this as a St. Mary's product. Do not put St. Mary's, do not put BizAd 123 on this thing. Do not put a St. Mary's logo on it, because no academics do this kind of work, in the real world. All right, so this is a professional deck, okay, and I want it to be agnostic. And then the second page is your outline, okay, and again, I work really, really closely with the students to make sure that there's no errors in this thing whatsoever, formatting, spelling, numbers, any of that stuff. I go over this over and over and over again until it's perfect. Once it's perfect, I approve it, and then you go to the print shop right underneath the power plant, and they will have the plastic covers. They will have the black wire binding. Do not use anything else than this type a binding, and a black back. Okay. Yes, go ahead.
Yeah, so you said not to brand it, but the
Do not put St. Mary's. Do
logo
not
of
mention
the
the
company
class
is
or
okay?
anything. Yes.
Okay.
Yes, but do not do St. Mary's.
Okay.
Okay. And then what I would do is once I've approved it and you go to the power plant, I would probably make a copy for each of your teammates and then maybe an extra copy for yourself. Because when you bring this into one of your interviews, you're going to show them and they're going to want to keep it. Okay. So you may want to decide if you want to give it to them or not. Okay. And this is basically graduate level MBA product. Okay. And we get it all the time where students go try to produce these things someplace else, and they go, "Wow, this is really nice. Where are you doing your graduate program?" "Oh, I'm an undergraduate at St. Mary's." "Really? You're doing this kind of stuff?" That's what I like to hear. You guys are doing graduate level work. Because if you go to the Ivy League, they don't teach the undergrad and the grad programs really any differently, other than the grad students have experience, but the content and the approach is exactly the same. Okay, so you can get a graduate level education at the undergraduate level at Haas at Berkeley. Okay, and that's kind of the way I'm trying to do it. So there's your overview right there. And then I would use Arial. I wouldn't use Times Roman as your font. When you're doing these pitch books and these decks, they should be in Arial and not Times Roman. Okay, it's cleaner. And then we got some, basic dashboard on the background of the firm. Okay, very quick. Just some of the key metrics of the company. Then you can put in, maybe the vision of the company, maybe some high-level goals, objectives, or you could even put in the mission statement if you want to. It's something that tells us a little bit about the company, its culture, and what it really focuses on. The next is really I would either probably have an org chart, you might want to put an org chart in there so you can see how the corporation or the institution is basically set up by divisional line. Usually the org chart, you've learned this in your management class or your organizational behavior classes, that the org chart basically reflects how the company is segmented to basically match up to the marketplace in regards to revenue generation. Okay. In these financial institutions, their organizational structures were basically restructured after the financial crisis and due to implementation of regulation under Dodd-Frank. So it's very fascinating if you look at the org structures of these banks 10 years prior to Dodd-Frank and now 10 years after Dodd-Frank. The org structures are fairly similar, but they've been restructured and they are actually different. Okay, Goldman Sachs has shifted more towards investment management, and JP Morgan and Bank of America have moved more towards commercial mortgage lending, and Wells Fargo has always been focused on really residential mortgage lending. Okay, and then we have the leadership. Okay, these pictures gotta look really, really good. That guy's a little distorted right there, so you may have to do some Photoshop cropping to get the pictures to look good. And that's where the marketing people come in. And this is a really good exercise, not only for the finance students, but everybody, and particularly the marketing students, okay? Because you're gonna be expected to be able to produce this quality of deck with this attention to detail. You just are, okay? Because that's why you went marketing. And then the leadership, it basically tells you the name of the person, their title, where they did their MBA. Most of them did MBAs or JDs. A lot of these guys, and most of them are guys in most cases, although Goldman Sachs seems to have been making an effort to diversify their leadership team. If you look at Wells is pretty diversified too, but you really don't see any minorities. They're all pretty much white people, and with more females being put in there recently. The leadership has to be divisional heads. It can't be boards of directors, or somebody who sits on the board. The board doesn't do anything. They're basically governance. They basically, in most cases, would just rubber stamp whatever the leadership brings them, and usually the CEO is the chairman of the board, although I think that's a conflict of interest, but usually the CEO wants to control the board, so usually they play dual roles. But there is a movement by institutional investors to separate the chair and separate the CEO to try to avoid some of that conflict of interest or principal agent problem that occurs when they hold dual roles. So you have their education, and then you have the number of years that they've been with the bank. So this very quickly kind of gives you an idea of the culture and the leadership of the company. And if you want to do a little bit more research when you're doing your presentation to talk about these people, go find out their leadership style. Go find out, if they are the charismatic leader that leads, initiatives and policies and administers, policies and initiatives and what other people think about them, what you can hear about them in the press or her. Then you're going to do a SWOT analysis, okay? And within the research, I'm going to have Sarah Vitale come in on Tuesday, and she's going to walk us through how to gain access to the information. Not only are you going to need information on Goldman Sachs, but you're going to need information on the other top 4 banks, JP Morgan, Citi, B of A, and let's see, Goldman, Citi, B of A, JP Morgan, and I think there's one more. So you're going to put together, when you start reading about the firm, in Mergent, it does have the SWOT analysis. But again, as you read about the company, you might want to add some things to the SWOT analysis, okay? So this very quickly, and actually this exercise right here is really almost a mid-program capstone exercise. You have to take the strategic management course in the last semester of your graduate year that kind of brings everything together within your program. This kind of does the same thing, okay? So you'll be exposed to this mid-program. Then the products and services, okay? So what are the products and services that actually generate the revenue growth at the end of the day, right? Using Gordon Growth, you want to know the growth rate and the cash flows. Again, these are the products and services where the bank basically generates not only the majority of their revenue, but where they get significant revenue growth. And these products and services, a lot of them are legacy and established products and services based on their comparative advantage, but some of the products and services are new, okay? And they're focusing probably on fintech and other types of new products to try to generate revenue growth or to penetrate market share from their competitors or create market share by introducing new products, by being an early mover in the process.
My deck has the products and services kind of towards the front.
Yeah.
And that one has it towards the end. Does it?
No, it's not. That's at the front.
Oh.
That's at the front too. And we can look at the order too later on, what you kind of produce. We can rearrange it if we have to make it so that it flows a little bit better. But what I like to do is I like to mark on these products and services. I use a star here and maybe even multiple stars to basically give us an idea of what products and services are the largest contributor to the revenue or the fastest growing revenue lines or product lines. Okay. What I like about this exercise is it's marketing. I love marketing, even though I'm a finance person. I love marketing. Marketing and finance combined together is just an awesome combo. And then we have the bank rankings. This is your peer group right here. And you'll be calculating the weighted average financial ratios from this peer group. Okay, and I'll walk you through those calculations. We'll get the data. I'll probably have you help me get some of the data. You'll be on your computers after Sarah trains you. You'll be on your computers. You'll be digging out the data that I need, and we'll basically solve the problem and do it as a laboratory, and we'll do this all together, and then you produce the product. But here are the top 5 banks. These top 5 banks basically control over 50% of all the bank assets in the United States. That's huge. And they actually are an oligopoly, okay? They're almost like a cartel. After the financial crisis, the concentration of assets within the top 5 banks, the Dodd-Frank was supposed to break up a lot of these banks, but actually what it did was it consolidated economic power amongst these top 5 banks, which makes them extremely powerful in Washington, D.C. Okay? And you've seen over the last 2 years under the Trump administration, you've seen a dismantling of Dodd-Frank and the regulatory oversight of these banks because they don't like Dodd-Frank. Okay? But Dodd-Frank hopefully will help prevent the next financial crisis, although I don't think it's going to, it really is going to help prevent it. But these are the top 5 banks. JP Morgan, Bank of America, Wells Fargo, Citigroup, and I stick Goldman Sachs in. US Bank, it probably should be fifth, but I really do like Goldman Sachs. They're a lot, really smart people. Okay. And then what you'll do is you'll sum these up, divide the total back to get the weights, and then you'll plug in the return on equity for all of them and calculate a weighted average, and that'll be your peer group. So if you do it in Excel, it'll be a lot easier. Because once you do one, you just copy and paste, put in ROA, copy and paste, put in debt to equity, whatever financial ratios, and I'll go through that. So here's the financial ratio analysis. There's 2 pages of financial ratio analyses, which you're going to conduct and state an overall financial condition and an overall financial position of the firm. This financial ratio analysis is basically the first step in the fundamental analysis to basically assess the overall financial condition and position of the firm. All these top 5 banks are very well run, so their financial condition and position are extremely solid. Okay, they don't rank low in these financial conditions and positions. They know how to manage their balance sheet, and they know how to invest in the assets. So here are the financial ratios. You got the profitability ratios here, and you got the leverage ratios here. You got, in this case, the target firm was JP Morgan. Our direct competitor was B of A. What I would do is I would use Goldman Sachs here, and I'd use JP Morgan, because really JP Morgan and Goldman Sachs really compete head-to-head against each other, although JP Morgan is twice the size as Goldman, but Goldman's extremely aggressive in what they do. They're extremely more aggressive than JP Morgan. And then you have the weighted average financial ratios, which are the peer group. I usually have some problems with some students. They usually just take an average of the peer group instead of a weighted average using the assets, which is wrong. You gotta use a weighted average. And then some of them will actually put in another bank, or they will put a bunch of banks in there and take the average, so they don't know what they're doing, okay? And they're just making stuff up. So you gotta do it like this, and I'll walk you through. And then the industry ratios, please somebody take a note to make sure that we ask Sarah, where do we get the industry ratios? Because there's at least 1,000 or 2,000 banks out there, and I'm not gonna make you calculate a 2,000 weighted average or 2,000 average on these things. So the industry ratios may be a little tough to get. We can guesstimate what those are and maybe do some observational, qualitative work to be able to just guesstimate what they are, because these are really a plug number. It's really the peer group and the direct competitor in which you conduct the analysis, and I'll walk you through that analysis right now. And then you're going to give an overall condition right here based on your financial ratio analysis. So here, what we did was JP Morgan, their net interest margin was 82.4%. B of A's was 80.5%, so they beat the direct competitor, and they beat the peer group, and they beat the industry. So actually, that could have been an excellent or a good. Now, the conditions are very specific, okay? You can't make that stuff up. You can't say, B of A, JP Morgan's, net interest margin was totally rad, awesome, or something like that. You can't use rad or awesome or is. So the financial conditions, I'll write that down. Board. Okay. So the financial conditions are very specific. Okay. So if JP Morgan totally blew out Bank of America in the peer group in the industry, you would give it either an excellent or a good. Okay. So you're going to have to conduct the financial ratio analysis. Then you're going to have above average. Which is, slightly above the peer group and slightly above or maybe equal to the peer group, but slightly above the industry, so you're going to give it an above average. If it's at the industry, and I'll write those notes in a minute, if it's at the industry, it's going to be average. industry, it's gonna be below average. And if it's significantly below the industry, it's gonna be poor. Now again, these are the top 5 banks in the industry. They're not gonna be poor. They're not gonna be below average or average in most cases. The only time I see that usually in these decks is the student didn't do the analysis, understand what we were actually doing and just basically made something up. Okay? But that's not gonna happen to you. So excellent is gonna be well above peer group and direct competitor. Good is gonna be, you know, above peer group and the direct competitor. Above average is going to be above industry. Average is going to be at industry. Below average is going to be below industry. And poor is going to be well below. So those are the conditions. So once you conduct the financial ratio analysis, you give the conditions right here, boom, 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 and you just study, and then you just do the analysis and boom, put in the condition. Then you step back and you take a look at the conditions, and you go, oh, look at that. We got 2 excellent and 4 good. I would say that the overall financial condition and position of the firm based on these sampling of financial ratios is good. Okay. Then you'll do another set of ratios. Again, here we got the equity ratios, PE, dividend yield, dividend payout. You got the growth rates for the revenue, a 3-year, this is all in merged, 3-year growth rate for the revenue, 3-year stock price appreciation. Okay. Again, put that in, you give the condition, you step back, you take a look at it. There's 3 excellents, 2 goods. I would say the overall financial condition and position of the firm is excellent based on this sampling of financial ratios. So now you're done with the underlying fundamental security, fundamental analysis, the first step in the fundamental analysis. Okay. And for you finance majors, when you take my investments class, we'll get more into this stuff. Then the first real valuation approach, it's not a fundamental valuation methodology, but it's a technical valuation methodology, which is the technical analysis, which you've already been exposed to on your first exam. Okay, so you're going to go to stockcharts.com. You're going to get a 3-year stock price chart with 10, 30, and 50-day moving averages on it. As you can see, right off the bat, they've identified the support line, the resistance line, the trend line, support line, resistance line. And then what you do is you basically just project out for a year. You take the slope of the line, you project it out for a year just in your head or with a ruler or something, and you look at where the stock price will be next year if this slope line continues. And then you put that price right there as the target price. Okay, so based on just the slope of the line, and if that slope of the line continues for 1 year, what's the stock price? Where would it be? That becomes the target price. You compare it to the current price, and then you calculate the premium or discount or whatever it is. Because the stock might be in an upward trend, but maybe in a sideways pattern or accumulation, consolidation phase. Then you have the technical analytics right here, upward RSI and MACD, which are the 2 technical indicators up here, so you're going to have to do a little analysis there. Upward movement, declining volume, we're going to look at the volume trend here, long-term upward price trend, and upward momentum. So those are the technical justifications for this first analysis. Then the second is where we get into the intrinsic valuation methods. You have the intrinsic, the perpetuity model. Okay? Now what you're going to do is you're going to calculate the expected return using the capital asset pricing model, and I'm going to ask you, how did you come up with the risk-free rate? Where did you get the beta? How did you come up with the expected market return? Okay, so there has to be some kind of justification. What we'll do is we will calculate the weighted average cost of capital for the firm. We will calculate the cost of the equity or the expected return on the equity using CAPM, And usually between those two numbers, we can get a range of discount rates, and then we just plug the expected market return, because the expected market return is between 8 and 10%. So we use that as basically the plug to get the three sensitivities, three discount sensitivities right here. And then what you're going to do is you're going to project out what the 2018 earnings per share is and what the 2019 earnings per share is. And since we're at the end of the year, we have to use 2019 projected earnings per share. And I will walk you through that. What we'll do is when Sarah gets here, she's going to teach us how to go back and get historical earnings per share for the firm going back over 2 cycles. And what I'll do is we'll list the earnings per share historically on the board. We'll black out the recession periods, and we'll look at the growth rate in the earnings per share and the recovery growth in peak phases of the business cycle going back at least 2 or 3 cycles. Because we're not in a recession, so why would we use a recession scenario for the projections of EPS? I could teach a whole class, on financial statement analysis, where we go through the pro formas to come up with the earnings per share, but we don't have time to do that. So we're just going to ballpark it and use basically observational analysis and business cycle analysis, trend analysis, which is more of an economic macro approach to the forecasting as opposed to doing the accounting approach. You'll learn that in your accounting, in your intermediate 1 and 2. Okay. So once you get the earnings per share for 2019, then you just divide it by the expected returns to get the valuations using the perpetuity approach. Then you have the range here. You're always going to sort the values from high to low. And then usually we pick the midpoint. So boom, you're done with that. Then the second methodology is the Gordon growth model. Again, we're using the CAPM model here, so you're going to restate that. We've got the earnings per share table here, and down here we have the valuation grid using the Gordon growth model. Here it's a little bit different because we have the discount rates sensitivities here, and we have the growth rate sensitivities along the top. Okay. Again, everything is already laid out for you. Don't create anything, just stick to the template. Okay. And make it look exactly like this. Okay. It's when the students start moving stuff around. How many of these things do you think I read per month, per quarter, as the managing director or portfolio manager at Goldman Sachs? How many of these things, how many stocks do you think we have in the portfolio?
More than 1,000.
Yeah, maybe 1,000. So I'm going to review maybe 100 or 200 of these things. So if anything is misplaced, do you think it's going to throw me off? Yeah, I can go through this thing in like a minute and check it. But again, if you start moving stuff around, it's going to throw me off. I'm going to get mad, and I'm probably not going to. I'm going to send it back and have you redo it, or I'm not even going to read it. If I was at Goldman, I wouldn't read it. It's just like you change the format around, go back and redo it, and maybe resubmit it next quarter because I don't have time. I got another 200 of these things to read. Okay, so here you got the sensitivity grid, and again, you can check your numbers in most cases depending on the sensitivities. And I'll walk you through how to calculate this grid. And then again, you have your intrinsic value here. There's the stock price, and in this case, we calculated a discount. Then we have the multiple approach. This is where a lot of students make their mistakes on this one too. Okay. So here we have the same earnings per share table up here. They usually don't do this grid here. This is really, really important because we have last year's PE multiple, we have this year's projected price earnings multiple, and we projected next year's price earnings multiple for the top 5 banks, because you got to use the peer group. So what we're going to do is we're going to be calculating multiples. I'll show you how to calculate theoretically the multiples, and then we're going to look at the multiples from the peer group, and then you're going to come up with the multiple sensitivities here. And the multiples are from high to low, not low to high, like the discount rates. These are from high to low. Okay? And then you got the sensitivities. You multiply by the 2019 earnings per share to get the intrinsic value. You pick the midpoint, the value goes there, and you calculate the premium or the discount. Boom, you're done. Okay. And a lot of the times you can do this stuff by hand. Okay, so it doesn't. If you did well on the last exam, this stuff's going to be easy for you. Okay, so a lot of it is just formatting. And the discounted cash flow, or the DCF method, I test you here to see if you know how to calculate the weighted average cost of capital for the company. I'll show you how to do it. You plug it in there, and then you're done. That becomes one of the sensitivities also. And then again, the problem here on the discounted cash flow, you're going to have the five earnings per share projections. You're going to have the growth rate underneath it. You're going to have the discounted cash flow underneath it. And over here, you're going to have to calculate the terminal value, which you add to the last year's cash flow, divided by the discount rate factor to get the total discounted cash flow in the final year of the holding period. Add them all up, and it should add up to that intrinsic value right there and match up to that intrinsic value right there. So I basically replicated the intrinsic values in multiple places within the PowerPoint presentation, so I can check things, constantly checking things. And that's what we do when we get these pitch books. We're checking everything. You're checking the periods, we're checking the numbers, we're checking everything. And if there's a mistake, either in formatting or there's a mistake in the calculations, we're going to totally question the whole report. Okay, so you don't want to ever get there. Okay, you don't want to ever get there. And then on the next page, you have the stock valuation, which you've seen before. You have the four intrinsic valuation methodologies. You have the three weighting scenarios. You have the intrinsic values. The middle column is the actual intrinsic value that you're going to use. In this case, it's a whole. And then the intrinsic value is there. And we calculate the discount. We decided that in this case, that, or from this analysis, that the discount was within a range of error, that we felt that it was more of a hold as opposed to a sell. Okay, so we did a hold instead of a sell on this one, which actually changed the recommendations. It's really easy, as you know, from the first exam and from your memos. If the intrinsic value is greater than the stock price, and you have a premium, or if you have a discount, the trade recommendations that you're going to be making to your clients or to the proprietary trading unit within your company are pretty much mechanistic, right? But in this case, under the hold scenario, which we might end up with a hold, I don't know. We'll see how the analysis goes. But in a hold scenario, that's all you do is you write all of your contracts, and then you sell short and write everything. Because if the stock price isn't going to go up significantly or go down significantly, and it's just going to trade sideways, I'd be writing the option contracts all day long. Because when the option contracts expire, I keep the money. That's all I make. So I can make money if the stock prices go up. I can make money when the stock prices go down. I can make money when the stock prices don't move at all. Okay, it's just knowing what they're going to do. So then we take the intrinsic value, compare it to the stock price, give the discount. We got 4 derivative trades because obviously JP Morgan makes up a significant portion of any financial services index, stock price index. Also makes up a significant portion of financial services exchange traded funds, and then the stock itself. So we have the 4 trades on the index, financial services, and the exchange traded funds, and the stock. And in this case, we have a total trades of 10. But if we had a buy or sell recommendation, we would have the sell here or the buy here, and we would have a total number of trades of 12. Okay. Then on the last page, you're going to list your references. You may not have used all of these references, but you need to have all of these references listed, because when you show this to somebody, you want them to think that you used multiple sources to come up with these this financial analysis. Okay. Then that's it. Usually in the back here, we would have the portfolio manager and then the 2 analysts, their names and their designations. We would usually have that, okay, but that's not required. And then the last point on this presentation that you need to be careful of is you need to, a lot of students, when they do the presentations, will end the presentation on this slide, okay? This slide tells you nothing, okay? Gives you the references, that's great, but usually, what I would do is I would show the references page, and then go back, flip back, and end it there. Here are the references that I made. Let's go back. This is the final recommendation. Any questions? That's it. Most of the presentations are 5. The best ones are 5 minutes. The ones that are good, that maybe the persons or the people within the team didn't practice their presentations and were reading every freaking financial ratio on the financial ratio page. You know, if you don't study and prepare for this stuff, you're going to start reading from the slides. Okay, once you start reading from the slides, you're slowing down your presentation. We think really quickly. We can assimilate information very quickly. We don't need you to drag on. Just give us some high-level takeaways, hit on the key points, and move on. Okay, and then make the transition between your speakers very smoothly. Don't forget to introduce your team up front and introduce your team member that's going to be transitioning. Make that transition. Make sure you pick somebody in your team who's going to be who will open really strong and who will close really strong. Don't put your weakest link up front or your weakest link on your team at the back. You need to pick the person who's going to sell this research and make a very strong recommendation up front and close the transaction. Okay? All right. Any questions on this? No? Okay. So, on the website, okay, on the website, if you go up to the website, there are some resources here for you. There's some valuation guides if you want to kind of dig into intrinsic valuation of financial institutions. I basically went through a bunch of my books, scanned the reports, and basically put them in there. So it's really backup material on if you want to read it, I would read it. If you don't want to read it, that's fine. But if you really want to learn some of the accounting and some of the underlying fundamental analysis around these very large financial institutions, these are really good primers in here. And again, if you learn how to do this, which I think you guys are in pretty good shape now, you can analyze any company. And that's actually what you need to do when you go for a job interview. If you're going to go work for a publicly traded company, you go do this analysis. Because what you're going to do is learn a lot about the company. And 2, you're probably going to be given stock grants and stock options. Anybody interested in that? Anybody interested in going to work somewhere where they're going to give you stock grants and stock options?
Yes.
Yeah. Okay. Yeah, I made about $500,000, you know, by getting stock options and stock grants from companies. Okay. And you can make millions of dollars if you go to the right company at the right time. You can make your millions or million by getting the stock grants and the stock options. And you're going to have to understand the valuation of the firm and where it's going. Because you don't want to go to a company that's imploding and their stock price is going to collapse in the next 3 to 5 years because they're going to get taken out by a competitor or by new technology, and they give you these stock grants and these stock options, and you work your butt off, and you find out 3 years later that your options are underwater and they're basically worthless. So you work for basically for free on that side. Okay, and then we have some intrinsic valuation research reports. I got some peer group financials, some examples of emergent extractions that Sarah will give you. Some of the stuff is kind of out of date, but it gives you kind of an idea of the research. And St. Mary's is some of the best research that I've seen from any of the other universities that I've worked with or work with. They have Standard & Poor's, they have Morningstar, they got Mergent, they got Dun & Bradstreet, they have all of these resources that other universities just don't have. Okay, so you guys are in really good position, and she'll come in and she'll show us that. So you have some industry research reports. Please do me a favor and make sure you remind me to ask Sarah to show us where the IBIZ, the International Business, I forgot what it means, and then the Standard & Poor's industry reports. Okay, but we should be able to pull the industry ratios from Mergent. That'll just be more efficient. And then some other industry and company research reports. You should also make a note to yourself to go up to the company's website, go under Investor Relations, and listen to the most recent quarterly analyst conference call. Okay, spend maybe 40 minutes, listen to the analyst conference call. Okay, because what you're going to do is you're going to be hearing from senior level managers within the institution. They may have the IT person, they'll definitely have the marketing person on the call. They'll have the investor relations, they'll have the senior level managers that will go over the macroeconomics, they'll go over the market conditions, they'll go over the competitive marketplace space, they'll go over the financial results for the quarter, benchmarked against their projections. They'll talk about goals, objectives, strategic planning going forth, and how they're going to not only manage the firm, but grow the revenues in the future. And what you'll end up hearing is that all of the language that you've learned in this class, everything that you've learned in this class is applied on that conference call, articulated within the communications to the marketplace. Okay, which I think is pretty cool.
Wait, that's just available on the website?
Yeah, yeah, on their website, on the Goldman Sachs, because it's a publicly traded company, so it has to disclose the quarterly financials, because they need to guide the market to maximize the stock price. So they have to be both transparent on the financial results, but they also want to guide the marketplace to guide the stock price to maximize the stock price. And if something significant happens in the marketplace that impairs the financial conditions of the firm in any way, either operationally or financially, they have to disclose it. Okay, so it's pretty amazing. And then we have here the student PowerPoint pitch books, although I've given you some of these, I can't promise that these are the best ones. But I put the B of A and the Wells Fargo up there, although I think these are the best. So what I would do is take pictures of as many of these as you can. And then let me take a look at it to make sure that you're using the right template. What else? I have some intrinsic valuation training videos from prior semesters. I will record my training video of the intrinsic valuation that we go over in this class. So there's already some training modules up there for you to review. Here's another series of stock intrinsic valuation research reports, example student presentations. I believe those are the YouTube videos. I'll double check those and make sure you get those so that you can watch that. And I think that's the section that you will be using for this application. Okay, any questions?
When are these due?
They will be, well, it's on the syllabus. It tells you when, what does it say on the syllabus? So what we did today was the orientation, stock valuation case study. We are going to also do training sessions on Tuesday, Thursday, the 13th and the 15th. And then
We start the presentations.
Then there'll be a draft. There should be a draft given to me on the November, like the 22nd.
Okay.
You'll have time. What's the week of Thanksgiving?
22.
It's the what?
The 22nd.
It's the
Yeah,
21st.
that's the same one.
It's the 21st.
Next Wednesday.
It's the 21st.
Yes.
Okay.
So should we have those?
Yeah, who's not going to be here that week? So that's the problem. People usually bail out the week of Thanksgiving. Like half my classes are gone.
But do we have Wednesday off as well?
I mean, I
Yeah,
think so.
Wednesdays.
Yeah.
It's Monday. It's Monday, Tuesday.
Yeah.
Is what it is. So, can you give me a draft
On that
on
Tuesday. right
Tuesday? Is
before-
that enough
Right
time?
before break.
Is that enough time to focus on that?
So the draft is this.
Yeah, draft.
Okay.
black and white. And then and then the following Tuesday, you would come in and do the Thursday, we would do the formal presentations.
Okay.
Okay? So really what I'm looking for on that Tuesday is just a draft.
The 20th.
It would be
Yeah.
yeah, it would be the draft.
Okay.
Okay?
To the very bottom, basically.
And then the question is, for the draft, do you wanna come in here and show it to me? Or do you wanna send it to me and do like a conference call or something? Do it virtual? We could do a Zoom room. Anybody use Zoom? Have you guys gotten Zoomed?
Yeah.
Yeah, you guys all need to get up to date on Zoom. Okay. So you go to the tech guys, get a Zoom, and get set up your Zoom. And we could do a virtual meeting. Have you guys done virtual meetings? WebExes and Zooms and stuff? Yeah, you need to know how to do that. So if you want, we could do that. You want to do that?
Can we do it like the people that are here can come in and the people that aren't can do the, or would it be like the whole class is doing Zoom?
I'm willing to be flexible on that.
Then
I'm
we
willing to
have
be
that
flexible
6 days
on it.
for that 4 days.
I mean, what you can do too is you could come on that Monday if you wanted, and then show it to me, or send it to me if you want to do that. Or you could show it to me the Friday before if you want to do that. I'm flexible, I just need to audit the presentation to make sure that it's done correctly and I can give you some feedback. So how do you guys want to do that?
Maybe we can decide next week.
Yeah, why don't you let me know?
Tuesday.
But I'm willing to be totally flexible, okay? Because I want to give you guys a break, for Thanksgiving. So I don't want to hold you,
So we could send you the draft on Monday, or would you want us to?
Yeah, you could send me the draft, or we could set up a Zoom room, or send me the draft, we could do a conference call.
Okay.
We could walk through the deck, I can give you my feedback, and then the following Monday, you could come see me again, right? If you want on that Monday. Just be ready, when you send me the deck, all right? I'll go over it with you.
Okay.
But when you come to present the PowerPoint presentation,
Yeah.
professionally dressed, on the Tuesday or the Thursday, the 27th and the 29th, okay? You want to print it out, but don't print it in color, and do not bind it. Okay, print it as black and white.
Okay.
1 page per slide, okay? And then staple it together for me, so that when you're doing your presentation, I have my, marking it up and giving you some comments,
But just one, just for you.
just for me.
Okay.
Okay, and then what we'll do is between then and the final period, you'll be working with me on a one-on-one, okay, to get the PowerPoint presentation perfected. And then once it's done, it's like, boom, go to the print shop, okay, and go print it out and go bind it, and you're done. Put it in your deliverable. Only the leader of the team, submits the final color-bound deck, okay? Not everybody, okay? Just you, just the leader, okay? All right? Is that cool?
Yep.
Is that gonna work for you guys? Give you a little extra time, a little flexibility. We don't have to be rigid about stuff. Now we move into more of the project phase of the class. So the homeworks are really small. Work with me on your memos to make sure those are perfected. Then you got the homework. I think they're like a half a dozen problems. Then you got the final, which is the 3. Then you got the pitch book, right? And then you got the resume. So your last deliverable is really small, okay? And then usually what I do is on the Thursday of the week of the finals, that Thursday, because everybody moves out on Friday, right? I usually throw like a little burger fest at the Metro in Lafayette.
Metro.
At the Metro. And then, and you're all invited to come, and we just have burgers and beer and stuff like that.
Beers?
Yeah,
Yeah.
yeah, it's pretty fun, if you're interested.
Yeah.
It's not mandatory. I like to throw a little party for my students at the end of every semester. Okay, how much time do we have?
30.
Okay, can you guys do your chapter 18 and 30? How many presentations we got?
18's not here. 18's
Okay, so you guys ready to go? Okay, let's do it. 20 minutes. Yeah, and those last chapters are really long. Just
We condensed
just
them.
perfect. Just edit them down. You know.
You said like 14 slides, you're like aiming.
Yeah,
30
yeah.
slides, 30, 35.
Yeah, you can just burn through them because really the core of the class is the intrinsic
A lot
valuation.
of them were like review terms from like previous things. Like
Exactly.
We would have done them in like
Totally.
accounting, so
You got it.
it was
Perfect. Perfect. And then while they're presenting, what I'll do is I'll go through any of the deliverables that still need to be addressed. I'll be over here on this side. I'm doing I guess, ad hoc office hour. So I'll be over there. I'll call you up.
When's Sarah coming in too? You know when?
I think it's the next Tuesday.
Oh, yeah.
I
I like
think,
that.
yeah.
I
But
like it. I like
you never
it.
know.
Yeah.
I think June.
I think the final day, you said we basically just get a deliverable to, like, you know, together for the first 30 minutes. It's gonna give us like,
Amelia? And then Logan, we're all set?
Yeah.
Okay. Well, were you still gonna take the exam? Yeah. Okay, you're gonna take it now? Yeah. Logan, did you wanna take anything? Were you gonna work on anything? Did you wanna work on this now and into the next session, or?
Yeah, I'll do that.
You wanna do that? Okay. And then let me know if you need any clarifications or anything. And Kevin?
Not here
No, Kevin, surgery. Tom?
Yeah.
Sati? Tom, are you gonna work on this? Okay, perfect. Awesome, and then put it in the delivery. And do you have a cover page?
Yeah.
Okay, got it. Dylan Robertson? Okay. Now, were you done with this, or are you gonna take?
No, I
Wanna
still
work
need to
on
work
this?
on it, yeah.
Okay,
Can I do it right now?
yeah, and then you can do it into the next session too. Just remind me at the end that you guys are in section 1. And then Hunter Payton, Camilo, let me finish this. Vincent,
Not here.
okay, Blake, Keith Coe,
Not here.
Nick Sparks,
Not here.
and Jasmine.
Not here.
Got it. All those guys to come pick up their stuff. At some point, I'm gonna lose it.
Alrighty, I'm Caitlin. I'm
Okay,
Gabi.
you did, okay.
I'm Miles.
Today we're gonna be focusing on chapter 19, it's financial planning and managing growth. So just go ahead and take a look at this chart, kind of see the different aspects that go into financial planning. The strategic plan, financial plan, investment plan, and financing plan. And we're gonna focus on income statement first, because that's what we've got on the homework, so let's get to that.
Okay, so there's two ratios that we'll use for this section. So it's the dividend payout ratio and the retention ratio. So you can see those formulas there. We're gonna go through the first homework problem, which deals with both of these. So this is basically just the table that they give you in the book. So as we saw before, the dividend payout ratio is dividends divided by net income. So just do that there, and it's 59.28%. And then the retention ratio is 1 minus the dividend payout ratio. So we'll just take what we figured out in the beginning, and then it's 40.72%. Next we go to capital intensity ratio, so you'll see it there. And the capital intensity ratio of a company is measured by the amount of capital needed per dollar of revenue. And then this is the next homework problem that deals with that. It's total assets divided by total net sales, so you'll see it there, 16.6%.
And external funding needed, growth and external funding. New investments are the projected capital expenditure plus the increase in capital working capital necessary to sustain increases in sales. Companies first report to internally generated funds in the form of addition to retained earnings. Once internally generated funds are exhausted, the firm looks to raise funds externally. And a mathematical model of the external funding needed is these two equations right here. And
And make sure you write these down, because
these are
for the homework.
what's on the homework.
Yeah,
Like,
these are the equations for the homework.
you know these formulas.
Yeah, and that's also gonna be on the CFA exam and probably maybe the CFP or maybe even the CPA exam.
In analyzing equation 19.6, which is the one right before this one right here, in analyzing that, first holding the dividend policy constant, the amount of EFN depends on the firm's projected growth rate. Higher growth rate implies that the firm needs more new investments, and therefore more funds have to be raised externally. Second, the firm's dividend policy also affects EFN. Holding growth rate constant and higher the firm's payout ratio, the larger amount of debt or equity financing needed. And this is just a graph of what I was just talking about, how if it's higher than the more funding you need. The internal growth rate is defined as the maximum growth rate that the firm can achieve without external funding. And here's the formula for that. The higher the retained earnings generated by firm, the lower total asset firm. The lower the total asset a firm has, the higher the growth rate possible without external funding. And the following equation relates IGR to the plowback ratio. 19.8.
Alright. So since we've been talking about internal growth rate, and we can solve for it, let's chat a little bit about what it is. So firms that achieve higher growth rates without seeking external financing have the following characteristics. So this is a way to kind of determine. They have a high plowback ratio, and they employ less equity and or able to generate high net income, lending to high ROE, and they are not highly leveraged. And the sustainable growth rate to finish off for the last equation of the homework. The sustainable growth rate is the rate of growth that the firm can sustain without selling additional shares of equity. This measure is important to management because it helps them determine whether they can avoid issuing new equity. So new equity issues are both expensive and cause dilution of earnings to existing shareholders. The SGR is a function of the plowback ratio and the ROE. So the SGR equals plowback ratio times the ROE, and that's the equation that y'all will need for 19.9.
That's also on the CFA exams.
That's it. Awesome.
Was anybody else go?
And no.
The other group's gone, I guess.
The other group is not here.
I think that's all I wanted to do today. I'm gonna do the, probably the international chapter later. I still need to edit it down. But, I think that's it. Yeah. No, it's, maybe you look at it. You can just show me later. Yeah, just show it to me later. Just gonna go. So double check. Double check. I'll show you the time. I work with those
I have to do it because I didn't get 124 and I was, my counselor had to take me at the same time to do that. And so they like, were like, oh my God, we're gonna make sure you graduate. I'm like, you read it, you did this. Yeah, it is on them. I was like freaking out. Yeah, it's just like, they don't know what they're doing. I was like, what the heck?
Yeah, we have,
No, they know what they're doing. They're like,
you'll have two people on your team?
how did you get in? Did you, they literally